Hi, this is Sylvia from IFRSbox.com and you're watching the short summary of the standard IFRS 13 on fair value measurement. This standard is relatively new as it was issued in 2011. IFRS 13 must be applied for the period starting 1st January 2013 or later, so that means that all guidance about fair value measurements in other standards like IAS 39 or IFRS 9 has been superseded and you just don't care about it. The objective of IFRS 13 is to define what a fair value is, to set out a framework for measuring the fair value, and require disclosure about fair value measurement. So please be aware that IFRS 13 guides you how to set a fair value and not when to apply fair value, and that's arranged by other standards. For example, if you classify the financial asset as at fair value through profit or loss in line with IFRS 9, then it is IFRS 9 that tells you when you can classify and measure that asset at fair value, but IFRS 13 tells you how to set the fair value. IFRS 13 defines fair value as the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction, well, that's not in a forced sale, between market participants at the measurement date. The price that would be received to sell an asset or pay to transfer a liability is called exit price. Let me also stress that fair value is market-based measurement and not entity-based measurement, so it takes market conditions into account. Fair value measurements requires an entity to determine all of the following. The first one, the particular asset or liability that is the subject of the measurement, and it must be determined consistently with its unit of account. Secondly, for a non-financial asset only, the valuation premise that is appropriate for the measurement, so the use to which the asset is put, consistently with its highest and best use. Number 3, the principal or the most advantageous market for the asset or liability. Number 4, the valuation technique appropriate for the measurement considering the availability of data, market participants, and the level of fair value hierarchy. So let's explain the basic requirements in more details. With reference to setting the particular asset or liability that is subject to measurement, you need to determine whether you're valuing individual or standalone asset or liability, or a group of assets or liabilities, and that depends on the unit of account for the asset or liability. While unit of account is the level at which an asset or liability is aggregated or disaggregated, and it is set by the standard other than IFRS 13 basically. Also, IFRS 13 requires an entity to consider the characteristics of the asset or liability when setting the fair value, mainly the condition and location of an asset and restriction on the sale or use of an asset or transfer of a liability. Fair value measurement assumes that a transaction to sell the asset or to transfer the liability occurs either on the principal market or, in the absence of principal market, on the most advantageous market for the asset or liability. Well, why is it so important? Well, because the same asset or liability can be traded in more markets. In the first instance, an entity shall look to the principal market. Principal market for some asset or liability is the market with the greatest volume or level of activity for the asset or liability. Well, different entities can have different principal markets for the same asset or liability. Well, how is that possible? Let's imagine that there are two different companies valuing the same shares. One company is a certified securities dealer or some broker, and the other company is just a manufacturing company. And let's say there is some interdealer market. Well, it means that only certified securities dealers are entitled to buy and sell on it. And retail market for the same security, where everyone can enter and make transactions. Let's say that the biggest volumes are traded on the interdealer market. Well, now what? Securities dealer can have access to both markets, so the principal market is interdealer market because of the greatest trading volumes. But the manufacturing company has access only to the retail market and not to interdealer market, so the principal market is the retail market. In this case, it doesn't matter that trading volumes are greater on interdealer market if manufacturer cannot access it. Now, what if there is no principal market? For example, the levels and frequency of trading of the same asset are about the same on 2 or 3 markets. Well, in such a case, the entity can consider the most advantageous market. The most advantageous market is the one that maximizes the amount that would be received to sell the asset or minimizes the amount that would be paid to transfer the liability after considering transaction and transport costs. So when considering the most advantageous market, you need to take transport and transaction costs into account, but when determining the fair value, you don't include transaction costs, just transfer costs. The transfer costs are those to deliver the asset to the market. IFRS 13 states that when determining fair value, an entity uses the assumptions that market participants would use when pricing the asset or liability, and these market participants must act in their best economic interest. So who are market participants? These are buyers and sellers in the principal or in the most advantageous market for the asset or liability. They must have the following characteristics. First, they must be independent on each other, and that means they are not related parties as defined in IAS 24. The second one, market participants must be knowledgeable. In other words, buyers must know what they buy and sellers must know what they sell. Market participants must be able to enter into transaction for the asset or liability, and also they must be willing to enter into transaction, not forced. Okay, also the prices must be based on the orderly transactions. Well, what does that mean? Orderly transaction happens when two key components are present. There is adequate market exposure in order to provide market participants the ability to obtain knowledge and awareness of the asset or liability necessary for market-based exchange. So, in other words, the asset or liability is traded frequently with actual current price quotations. And the second component is that market participants are motivated to transact for the asset or liability and are not forced to do so. In relation to non-financial assets, IFRS 13 requires to measure the fair value based on the asset's highest and best use from a market participant's perspective. That takes into account the use of the asset that is physically possible, and it takes into account the physical characteristics that market participants would consider, for example, property location or size. Then legally permissible, and it takes into account the legal restrictions on use of the asset that market participants would consider, for example, zoning regulations, or financially feasible, which takes into account whether use of the asset generates adequate income or cash flows to produce an investment return that market participants would require, and this should incorporate the cost of converting the asset to that use. The highest and best use of a non-financial asset may be on a standalone basis, that's individual asset, or it may be achieved in combination with other assets and or liabilities, so the fair value is based on the use of the asset in such an asset or liability group. In this case, the synergies associated with the asset liability group may be reflected into the fair value of the individual asset in a number of ways. For example, some adjustments via some valuation techniques are possible. Let's see how IFRS 13 applies to setting the fair value of liabilities and own equity instruments. The general principle is that an entity shall assume transfer and not settlement of the financial liability or own equity instrument. And it means that the liability continues and the buyer of the liability still has to fulfill the obligation. So how to set the fair value? Well, is there a quoted price of that instrument in an active market? If yes, then use it. If not, then is there identical item held as an asset by another party? If there is some, then an entity shall measure the fair value of liability or own equity instrument in the same way as an entity would value the corresponding financial asset from the perspective of holder of that asset. Sometimes an entity needs to adjust the fair value of corresponding asset because there might be some factors specific to that asset that are not applicable for liability or own equity. If there is no corresponding asset held by some other party, then an entity must use some valuation techniques. For example, in measuring decommissioning liability, an entity shall apply some present value technique, while the estimated cash flows shall include market participants' expectations about cost of fulfilling the obligation and compensation that the market participant would require for taking on the obligation, including some risk premium. Let's outline the other principles for setting the fair value of liabilities and own equity instruments. Fair value of liability shall reflect the risk of non-performance. That's the risk that the entity will not fulfill its obligation, which includes, but is not limited to, entity's own credit risk, and that might be different for different types of liabilities. So let's say there are two entities. The first one is very well funded with high AAA rating, and the second one has some liquidity and other financial problems with BB rating. As a result of their different credit rating, their borrowing costs are different, and therefore they might need to discount their liabilities with a different discount rate derived from their borrowing costs. Let's go on. A liability or entity's own equity instrument may be subject to restrictions that prevent the transfer of the item to somebody else. But when measuring the fair value of a liability or equity instrument, IFRS 13 does not allow an entity to include a separate input or adjustment for such restrictions. That's because the effect of the restriction has already been included in other inputs. So if you spot a transfer restrictions on a liability or own equity instrument, just don't take them into account at your valuations. Then, the next specific feature of the financial liabilities can be demand feature. It means that the liability can be payable on demand. In this case, the fair value of a financial liability with demand feature is not less than the amount payable on demand, discounted from the first date that the amount could be required to be paid. Fine. Now, we have explained that the fair value measurement is market-based and not entity-based. There is one exception to this rule: financial assets and liabilities with offsetting positions. What is it? Well, some entities might hold some group of financial assets and financial liabilities in order to manage some market or credit risk by offsetting. The example of market risk is foreign currency risk, when an entity might hold the assets and corresponding liabilities in the same foreign currencies, so the foreign exchange gains from assets are offset with foreign exchange loss from liabilities, or vice versa, just as an example. In such a case, IFRS 13 allows to measure the fair value of a group of financial assets and financial liabilities on the net basis. Either the price that would be received to sell a net long position, that is asset for a particular risk exposure, or pay to transfer a net short position, that is liability, for a particular risk exposure in an orderly transaction between market participants at a measurement date under current market conditions. Let me say that this is the choice and you don't need to do this. In order to apply this option, company must fulfill 3 criteria. There must be some documented risk management or investment strategy on this point. It must provide information on that basis about the group of financial assets and financial liabilities to the entity's key management personnel. And the entity measures those financial assets and financial liabilities at fair value in the statement of financial position at the end of each reporting period, so not at amortized cost or on some different basis. Now, let's discuss the fair value on initial recognition. Basically, when an entity acquires an asset or assumes a liability, the price paid or the transaction price is an entry price. However, IFRS defines fair value as the price that would be received to sell the asset or pay to transfer the liability, and that's the notion of exit price. In most cases, in the market transaction, entry price equals to exit price because one market participant enters the transaction and the second one exits the transaction at the same price. But there are some circumstances or indicators that the transaction price is not necessarily the same as fair value. First, the transaction is between related parties. The second indicator, the transaction takes place under duress or the seller is forced to accept the price in the transaction if under some financial difficulties or similar. The third indicator, the unit of account represented by the transaction price is different from the unit of account for the asset or liability measured at fair value. The fourth indicator, the market in which the transaction takes place is different from principal or most advantageous market. So what to do when you find out that the fair value is different from transaction price? In this case, difference between these two is so-called day one profit. And if it cannot be attributed to transaction cost, you simply recognize it to profit or loss immediately. When determining fair value, an entity is required to use valuation techniques that are appropriate in the circumstances and for which sufficient data are available, and these techniques must maximize the use of relevant observable inputs and minimize the use of unobservable inputs. IFRS 13 recognizes three main valuation approaches. Market approach. The market approach uses prices and other relevant information generated by market transactions involving identical or comparable assets, liabilities, or group of assets or liabilities, such as a business. For example, you can use market multiples derived from set of comparables. Typical example is the use of earnings before interest, tax, and depreciation and amortization, EBITDA multiple, for valuing some business. Another example of market approach is matrix pricing. That's mathematical technique used principally to value some types of financial instruments. Another valuation technique used by IFRS 13 is cost approach, and this technique is applicable mostly for non-financial or physical assets. The cost approach reflects the amount that would be required currently to replace the service capacity of an asset. That's often referred to as current replacement cost. Here, an entity needs to take obsolescence of the asset into account because the price to sell the asset is based on the price that somebody else would buy the asset for, adjusted for obsolescence. Well, what is it? It is simply physical deterioration of asset, or functional or technical obsolescence, and economical obsolescence too. So something like decreased functionality due to wear and tear, or existence of newer technologies, etc. The third approach is income approach that converts future amounts, cash flows or income and expenses, to a single current or discounted amount. When the income approach is used, the fair value measurement reflects current market expectations about those future amounts. The examples of such approach are present value techniques, that use estimations of future cash flows and discount them to present value, then option pricing models, the multi-period excess earnings method, and many others. So here we drafted various kinds of valuation techniques. IFRS 13 does not give priority to one or another. That's up to judgment to use, but you shall maximize observable inputs, and that is use market data as much as possible, and minimize unobservable inputs. In other words, you shall probably utilize market approaches first if possible, as they use the observable market inputs, and only then apply other techniques such as present value techniques. Let me also say that you should be consistent in applying one valuation technique. You can change valuation technique, but that's treated as change in accounting estimate in line with IAS 8, so you should have a good reason to do so, and you need to disclose the fact. Okay, we have just gone through various valuation techniques outlined by IFRS 13. And while IFRS 13 does not give preference to one technique over another one, what it does is that IFRS 13 gives priority to certain information or inputs into these techniques over other inputs. The basic rule is that the entity shall always prefer the use of observable inputs because they are more reliable, and place less importance to unobservable inputs. Therefore, IFRS 13 categorizes various inputs to valuation techniques into fair value hierarchy. The fair value hierarchy classifies inputs into three levels. Level 1 includes quoted prices, unadjusted by some risk premium or discount, in active markets for identical assets or liabilities that the entity can access at the measurement date. The examples of Level 1 inputs are quoted prices of equity shares traded on the stock exchange. Level 2 inputs are inputs other than quoted prices included within Level 1 that are observable for the asset or liability either directly or indirectly. For example, quoted price for similar asset or liability, quoted prices for identical or similar assets or liabilities in markets that are not active, inputs other than quoted prices that are observable for asset or liability, for example, interest rates and yield curves, and market corroborated inputs. Level 3 inputs are all unobservable inputs for asset or liability, like financial forecasts, historical volatility, and thus volatility of the shares derived from shares' historical prices, and it's used for valuation of call or put options related to shares. Adjustment to mid-market consensus prices. That's when the prices are set in bid-ask spreads to cover dealers' margin. An entity shall maximize the use of Level 1 inputs. If these are not available, then use Level 2 inputs, and only if these are not available, use Level 3 inputs, but really, you shall minimize the use of Level 3. Finally, let me warn you about quite extensive disclosures related to fair value measurement required by IFRS 13. The objectives of IFRS 13 disclosure requirements are to enable users of financial statements to understand the valuation techniques and inputs used to develop fair value measurements, and help users to understand the effects of fair value measurements on profit or loss and other comprehensive income for the period when fair value is based on unobservable or level 3 inputs. So here, the use of level 3 inputs needs to be understood as much as possible. There are numerous disclosures necessary for all kinds of fair value measurements, with distinction for recurring and non-recurring fair value measurements too. So that was the short summary of IFRS 13. If you'd like to learn more, please visit our web IFRSbox.com and subscribe to the free IFRS course and find more IFRS stuff there. Bye and thanks for watching.